Hello and welcome to my morning note. If you haven't heard already, the very big news this morning is that Bob Diamond has resigned as the CEO of Barclays over the LIBOR scandal. Plainly an extremely significant event both for the City of London and for the global financial services industry more broadly. And I think I can promise that there will be an awful lot more coverage of that on ft.com as the day proceeds. For now, I'd like to talk about an arguably even more important topic, which is the reaction to last week's EU summit, which, to judge by the ecstatic response on the equity markets, is being judged to be a game changer. Was it really a game changer, and in that case, what exact game have we been playing? With me now for a perhaps more sceptical view on all of this is the chairman of Lombard Street Research here in London, Charles Dumas. Charles, thank you very much for being here today. Now, as I understand it, your take on this would be that ultimately we need to look far more broadly than the EU, and that it's very difficult for the EU itself to put sticking plasters over the problem. Is that a fair summation?
Yes, I believe that we've got a global growth problem arising from a combination of policies right around the world and also just straightforward behaviour patterns,
right.
Which makes a difficult environment for any kind of recovery. And
that particularly presumably would be to do with the over-saving that is going on at a global level. We're looking at here as savings as a percentage of global GDP, with predictions for where it's going. How does that affect the Eurozone or indeed the US and China?
Well, you can see that in 2007 it reached its all-time high, and that was because the Americans ceased to be able to borrow as much as they had before to keep the world on the move, and we went into recession in the first quarter of 2008. The projections for this year, this is IMF projection, is that it goes higher than in 2007 and onward and upward, so to speak. And what we say is the reason for this is an accounting reason, not a real reason, namely that there are sharp reductions in government deficits around the world, which are a form of dis-saving, if you like. So this just reflects the idea that everyone else will be fine. The drawback is a simple one, and that is that globally, saving equals investment. And so the essence of the IMF forecast is that owing to an extremely restrictive and aggressively negative fiscal policy, we're suddenly going to get a global investment boom that causes investment to go up as fast as this savings chart suggests. And of course, that isn't going to happen, and so we're going to have a relapse.
Right, and that's particularly unlikely to happen here in Europe, given the current policy direction that we're taking. Let's now talk about how that underlying problem applies to Europe. This is borrowed from your most recent research, unit labour costs over the life of the Eurozone, and we can see that the Euro, we've made this point many times, but the Euro really didn't achieve its goal of bringing convergence between the European economies. How does this vitiate the deal that's been struck at the summit?
Well, it doesn't vitiate it exactly. It's simply that people have got to make up their minds how much they're prepared to pay and for how long. And as long as the relative costs are going out of line, as they are, as you can see from this chart, then there will be no recovery in places like Italy, and the debt ratio will go up, and so the amount that will have to be paid to them will continue to rise. And so there is really only one solution to the problem implied by this chart, which is, of course, either the Irish solution, in other words, a collapse of the economy, mass emigration, etc., etc.
But you do at least make yourself more competitive.
Yeah, but you become more competitive. Also, in their case, they have exports at 100% of GDP, which makes it easier. Or it is the alternative solution is inflation in Germany. And the Germans don't like inflation, and they're not likely to get inflation in a world which is, as we've just discussed, relatively depressed.
So by your logic, what perhaps we should be negotiating is an amicable separation of the euro itself. If those alternatives aren't going to fly, it's about dismantling the euro with the minimum of damage.
If you want to get back to growth in Europe within, let us say, a year to a year and a half, then that's the only route. It is also politically, of course, quite an attractive route for Mrs. Merkel, because any alternatives involved holding the euro together with or without Greece are going to involve a constant series of retreats and extra payments that weren't previously anticipated, which German people are quite reasonably going to hate. As a result, she's liable to get slaughtered in next September 2013 general election. So the only way she can actually get a grip apart from consolidating onto the narrow euro, the Euro as it's called, which the French won't permit because it leaves them uncompetitive.
Right.
Apart from that, the only way to get a grip is to dismantle it.
Okay, Charles, thank you very much indeed. I think we can take from this analysis one thing very clearly: anybody who really thinks that the problem is over after the technical measures at the last summit is being very hopeful indeed. But please do enjoy the rally while it lasts.